And as I had promised you earlier in my last lesson, that I was to teach you how to calculate taxable income. In this particular case, it is a unique case because in our previous lesson we have been looking how to calculate income tax payable. But here we want to calculate taxable income. This is a unique case whereby we might be given a case, we are given variables in our guiding principle that we have already learned. We are given other variables, but we are not given the taxable income. Which guiding principle am I talking about? I'm talking about taxable income. Taxable income is equal to total gross income minus total pre-tax deductions. These are the variables I'm talking about. You are faced with a situation whereby you've been given either this, or the two of them, and then you are not given the taxable income. So you are required to calculate the taxable income. And remember, under this total gross income, we learned that it has several components. We can have income from employment, income from employment, and we can also have income from part-time jobs. Part-time jobs. We have a situation whereby you can have also income from interests in investments, interests from investments. All this will contribute to our total gross income. We are not just talking about gross income, but total gross income, because all these components will contribute to that. And when we talk about the total pre-tax deductions, here we can have things like donations to charitable organization, we can also have some work-related expenses. And when we talk about donations to charitable organizations, this must be registered and recognized charitable organizations. We can also have some work-related expenses. These work-related expenses must be supported by invoices and receipts, so that we can make pre-tax deductions before we effect the taxation. And by now you also know what a tax table is, the different tax brackets that we have and how they apply. And the questions whereby we are required to calculate taxable income, they vary from the simple ones whereby you just substitute in the variables, the given variables, and get the answers to some complicated ones, as we will see from these examples that we are going to look at. Let us look at our first example so that we can understand what we are talking about. And even before we talk about the examples, some of you might confuse these two principles or rules that we have. The one that I've just deleted, which is a taxable income, being equal to gross income. This should be total minus total pre-tax deductions. And you remember we also had another one in our previous lessons where we were looking for the net income. These are two different cases. The net income, I hope you remember. How did we calculate the net income? The net income was equal to gross income minus total deductions. Total deductions. We have two deductions here. In the first case, we are talking about total pre-tax deductions. These are the deductions made on the total gross income before that amount that remains, which we are calling the taxable income, goes through the various tax brackets with the aim of getting the income tax payable. This particular process gives us income tax payable. Income tax payable. And in the second case, when we talk about the gross income, this gross income can have the components that we have just talked about that can be found in the total gross income in the first case. But when we talk about the total tax, the total deductions, these deductions are not similar to the first ones in the first case. These deductions basically includes total tax payable. Total tax payable, where we can have the tax that we have calculated from the tax bands or from the tax table, and also we add on the tax payable plus the Medicare levy. The Medicare levy. So these two deductions are different. One is made before the taxable income goes through the various tax brackets with the aim of achieving the income tax payable, while the second type of deductions that I'm talking about will help us to get net income. And I also hope that you remember the definition to the word net income and also the gross income. Let us now move on to examples. Our first example is Samson works in the motor vehicle assembly plant. Assembling plant. He earns a gross income of 42,000 and $60. He is a member, he is a board member of a children's orphanage. He is a board member of a children's orphanage. Children's orphanage. You know, we have several types of orphanages. We can have one for children, and also we have the animal orphanage. So we are talking about the one concerning the human beings, where he donates 10% of his gross income. 10% of his gross income goes to the charitable organization. So the question is for us to calculate Samson's taxable income. We need to calculate his taxable income, where he earns, he works in a motor vehicle assembling plant, and he earns a gross income of $42,060, of which he donates 10% to the children's orphanage. So we need to write down our guiding principle. That is step number 1. We write down our guiding principle, and we have said that our taxable income should be equal to the total gross income minus the total deductions. It is important to write down the guiding principle, the guiding rule, so that you can see the various variables that we have, and it will also help you to remember. Maybe you might have forgotten something. We want to get the taxable income. Do we have the gross income? We need to identify that. Yes, we have our gross income, and it amounts to $42,060. Do we have deductions? Yes. What type of deductions do we have? We need to get these deductions. These deductions are basically donations. They are donations to a children's orphanage, and these donations, we are told that 10% of the gross income. From the statement that we have, this is the information we can extract, and it is actually very important information. So for us to get these deductions, we need to get 10% of the gross income, and this will be 10% of $42,060. For us to do this, we need to convert. I know you have learned how to get a percentage of given amounts and quantities. First of all, we need to convert, to write this as a percentage before we multiply by that particular figure. This will be 10 out of 100, and off means multiplication. We multiply by this given amount. And these donations will be equal to, this 0 can cancel with this, and this can cancel with this. So our donations will be $4,206. Those are the total donations. if we have that donation, and also remember we have our gross income. Our gross income is $42,060. So we substitute these two variables in our guiding principle so that our taxable income will be the same, will be equal to $42,060 minus $4,206, giving us a figure of $37,854. This is what we have as our taxable income. This is just but one of the examples. Let us look at some other examples and see how they will behave. Do we apply the same concept, or we need to think a bit? As humble as this second example might look, we are told Alex Medicare levy is $1312.50, and this is 1.5% of his taxable income. Of course, Medicare levy is usually at 1.5% of the taxable income. So what is his taxable income? The question is, what is his taxable income? What is his taxable income? When you look at the Medicare levy, it is part of the deductions we have before someone earns a net income. So it's just but one of the aspects. A very important statement that we can extract from this question is Medicare levy is equal to 1.5% of his taxable income. His taxable income. A very superb statement, a very good statement, and it is a leading and guiding statement when we are trying to solve this particular question. If this Medicare levy is 1.5% of the taxable income, and we are looking for the taxable income, so what we are going to do is to get, if this this particular amount is 1.5% of this, what about 100%? Remember, we have already looked at how do we get percentages of given quantities in our previous lessons. So, if 1.5% represents $1,312.50, what about 100% that we presume is equivalent to our taxable income? Which is actually equal to our taxable. What will it be? This calls for cross multiplication, whereby this will be multiplied by that, while this will be multiplied by that, so that 1.5% will be multiplied by our taxable income, which we are trying to find out, and this 100% will be multiplied by $1,312.5. So we are looking for this. We can make it the subject of the formula by dividing all through by 1.5%. We divide. What is done on one side of the equation should be the same should be done on the other side of the equation. So this will cancel with that, and our taxable income will be equal to the product of these two. Then later on we find the quotient. The product, and then we find the quotient. And when we do that, we are going to get our taxable income as $87,500. This is Alex's taxable income. Remember, we were just given some scant information, just a fraction of what we would have wished that they give us, but from that information we have been able to calculate this particular taxable income. This is the second example. Let us look at our third example, and if time will allow, we can also look at our fourth and fifth example. This third example is somehow a bit easy. When somebody called salad, when salad used the tax table to calculate his income tax, payable, income tax payable, it turned out to be $23,097. What is his taxable income? In this particular lesson, we agree that we are going to calculate the taxable income. So this particular question requires us to look at the tax table that I know you have a copy of by now, that after calculating the income tax payable, it turns out that the amount is $23,097. And if we look keenly, tax table that we have, this particular amount will actually must have come from somewhere. If we look at the second tax bracket, the tax, income tax payable cannot have come from here. We're looking at the third one. We have a figure that is somehow close to the information that we have in this particular table. When you look at it, we are told that in this particular tax bracket, we have a base tax of $3,000, which is much below $23,000. When you look at the fourth one, we have something close to that, which is actually $17,547. So how is it going to help us? This figure is closer to that, but when we try to look at the fifth one or the last tax table, it is way above that. So this amount must have been calculated from the fourth tax band. It must have been calculated from the fourth tax band. So we can say the income tax payable of $23,097 must have been calculated from the fourth tax bracket. From the fourth tax bracket. So we must know in this fourth tax bracket what is the guiding formula that is used to calculate the tax payable from that particular. Income tax payable. The rule is that one who earns an income that ranges between between $37,000 and $80,000 will pay a base tax of $17,547. And on top of that, we have an addition of 37 cents for every dollar and above $80,000. So in that particular rule, you know, that difference is usually about it is usually about taxable income minus the ceiling in that particular bracket. Minus the ceiling in that particular bracket. The lower ceiling in that particular bracket. Maybe we can look at it. We usually take, as we have done in the other examples, we take the taxable income minus this particular ceiling here, this one here, 80,000. So because anything earned above that will attract a tax of 37 cents for every dollar. So this will be taxable income minus $80,000. And we have already been given the income tax payable. The income tax payable we have already been given is this. That at the end of all this operation, we will end up with this particular figure. After applying this particular rule, this person ended up with this particular figure as the income tax payable. So we will say our $23,097 is equivalent to the entire operation on the right hand side. Remember, we can convert this is 27 cents, so we can write it as 27 out of 100, because a cent means out of, it means 100 parts. Cent means 100 parts, so 37 cents means 37 out of 100. And then we have our bracket, taxable income, that we are calculating. That is what we have. If we want to simplify this, we can take this particular amount, this one, to the other side of the equation. We are trying to collect the like terms. So this will be $23,097. Since it is crossing the equal signs and it is positive on the right hand side, it becomes negative. Or we can decide to subtract this 17,554 on the right hand side, and if we do that on one side of the equation, the same should apply on the other side of the equation, or of the equal signs. This will be $17,547 should be equal to 37 out of 100 into our taxable income minus this particular figure here. When you subtract this, we are actually going to end up with 5550. We are going to end up with $5550, $5,550, and this should be equal to 37 out of 100 multiplied by our taxable income minus this particular ceiling, because every dollar above that attracts a tax of 37 cents. This is a very nice question. Let me rewrite the expression here. So how do we simplify so that we end up with our taxable income? We can decide to open up the brackets, or we multiply both sides of the equal signs, or both sides of the equation, by the reciprocal of this particular figure here, so that we eliminate it from the right hand side. If we do that, we are going to multiply here by 100 out of 37, and we multiply this side also with 100 out of 37. You will realize that this 100 and this one will cancel, and this 37 will cancel with that. So we no longer have this particular constant on the right hand side, but we have moved it to the left hand side. So that means if we multiply this now, if we multiply this, we will end up with $15,000. This operation here will give us $15,000, which should be equal to our taxable income. Our taxable income minus $80,000. We want to remain with the taxable income on one side alone. How do we achieve that? We move this particular figure to the other side of the equation so that we remain with this one alone. And in fact, we can rearrange the entire thing by starting with the taxable income. But we can still say $15,000. On this particular side, $80,000 has a negative sign. So if it crosses to the other side, it becomes positive. This will be plus $80,000. Sorry. This should be equal to our taxable income. This should be equal to our taxable income. And this actually will give us our taxable income as the sum of these two figures. And when you add 80,000 and 15,000, you will get $95,000. This is what we were looking for. All that operations that we have done and all the manipulations, we wanted to achieve our results that should be equal to our taxable income. This is our third example. Let us look at another example that is similar to our last one so that we see how we can solve the same. Very similar to the last one. Our fourth example, where we are told someone by the name Mary used the given tax table to calculate her income tax payable. That amounted to $32,000. What is her taxable? What is her taxable income? What is her taxable income? So you will realize that with this particular amount, we need to go back to our tax table. Try to find out which tax bracket could they have used. And this definitely should be the last tax bracket where we have a base tax of 54, because it is already, it should be the fourth tax bracket, because when we look at the fifth or the last one, the base tax alone is way above that because it is at around $54,000. And what we have is $32,000. So we know if we subtract $17,547 from that, whatever remains will be accounted for by this particular factor of 37 cents for every dollar above 80,000. So this amount, the calculations were based on the fourth tax bracket. The fourth tax bracket. And in the fourth tax bracket, what do we have? We have a base tax of $17,547 plus an additional of 37 cents for every dollar that is earned above $80,000. And in this particular bracket, we have our taxable income. We have the difference between the taxable income and the ceiling provided in that particular. That after $80,000, anything above that will attract a tax of 37 cents for every dollar. So we take our taxable income, we subtract that particular ceiling of $80,000, and everything here should be equal to $32,000. Should be equal to $32,000. So we are saying 17,547 plus 37 out of 100 into bracket our taxable income minus the ceiling provided, which is $80,000, should be equal to $32,000. We can decide to subtract this from that so that we can have 37 out of 100 into our taxable income minus the ceiling provided in the fourth tax bracket should be equal to 32,000 minus 17,547. And this will give us 37 out of 100, our taxable income, minus $80,000 should be equal to 144.53. $14,453. So we can decide to remove this particular factor, this constant here, by multiplying both sides. Remember, we have 37 out of 100 into bracket our taxable income minus $80,000. This should be equal to $14,453. So to remove this particular constant here, as we did in our previous example, we multiply by the reciprocal of the same on both sides, so that this and this will cancel, this and this will cancel, and we remain with our taxable income minus $80,000 should give us this. When we take 14,453 times 100, then we divide the answer we get by 37, we end up with $39,062.16. But we are looking for our taxable income in this particular equation. Everything is being done or operated upon to achieve this. This is what we want. This is our cent of interest. So our taxable income will be equal to, we take this from the left hand side to the other side of the equation, will be 39.62.16 plus, remember it is negative, so when it goes to the other side it becomes positive, plus 80,000. And this will give us 119,062.16 dollars. This is the taxable income that this particular lady by the name Mary earns. And we can still confirm whether we used the right tax bracket. Remember, we have been using the fourth tax bracket, and this amount should fall within the stipulated range in the fourth bracket. When you look at the fourth bracket, we are told that the taxable income should fall within a range of 80,001 and 180,000. So when you look at 119 is within that particular range. So we used the correct tax bracket. So this is the amount we were looking for. I want to hope that the calculations of the taxable income that we have just done in the 4 examples that we have gone through together have been of great help to you, and you have understood the concept. Remember, the two first questions were a bit simple, but this one required us to think a bit, and I hope you have enjoyed my lesson. So in our next lesson, we will be looking at what we call legitimate deductions. Before we meet in that particular lesson, you can do research on this. What do we refer to as legitimate deductions? And if we have legitimate deductions, does it mean that we also have illegitimate deductions? Let us find out in our next lesson. Thank you.